Hello, welcome to the one video, one of one for Chapter 10. Chapter 10 is an interesting chapter in that it's kind of a bridge chapter between budgets and variance, which is the next chapter, Chapter 11. And although there's not a lot of calculation, there is a good deal of knowledge items. And just because there's not a lot of calculation doesn't mean it's not a very important set of concepts for the company. So let's take a look at what we've got here. So whenever you have budgets, that's what you plan on doing. So those are your budgeted, your required budget or what you're planning on doing. At some point, you're going to have actual results. And when you compare your actual results to your budget, there's going to be a difference. And in accounting, we call that the variance. And there's a lot of information we do when setting up budgets. When we have actual results, there's a lot of things we do when we calculate the variance, which is the next chapter. But think about what it means that we didn't achieve the budget or we did achieve the budget. We either went over or under the budget. The actual results were either better or worse. And while we discuss a lot of that in Chapter 11, how to calculate did we do better or worse through the variance, Chapter 10 kind of talks about what are the consequences. What are the consequences and how is this set up? In other words, having actual results and therefore understanding whether you did better or worse has a lot of consequences. Who's responsible for it? How do you assign responsibility? Who's accountable? What departments? And so because of that, this chapter focuses on just the reporting and the understanding of how you would assign, the results of any operation to different people. And so we have a lot of information, and you'll see that of the learning objectives, the first and the last one here, number 1 and number 6, the first one talks about, well, how do you group together the responsibilities? And number 6 talks about, well, what would be the physical manifestations? How would you actually go about tracking this through a balanced scorecard or key performance indicators? So let's talk about the first one. The question itself is a bunch of kind of fill-in-the-blank knowledge questions, so I'll refer you to the textbook and to the PowerPoints. But just in general, here are kind of 4 of the main items. So decentralization, there is an explanation in the PowerPoint and the textbook, but the responsibility centers kind of focuses on these items here. And it's a fairly simple concept. This kind of basic one is a cost center may be one that is only focused on costs, right? So if you're a big company that has a captive manufacturing plant, it's not like you're selling to the public. You may be just selling to the other divisions at a set price. And so really what you're focused on is minimizing cost. Similarly, within a multi, functional company, you may have a manufacturing facility that sells your distribution or your retail centers with a bunch of product at a set cost. So what you're focused on the storefronts is actually what is your top line, maximizing, I guess, sales. So this would be minimizing costs. A revenue center is kind of a combined object. So perhaps overseas, or perhaps you've set up your company to where it's regional. So maybe the West region has both a factory and storefronts, and the headquarters may want to track both their costs and their profits. So they may be tasked with making things and selling them, so minimizing costs and maximizing sale. So that would be a revenue center. That would be looking at both of these. And then an investment center is, and that's kind of where we'd say bring in an international vision. So you have your U.S. center, and then you have your internet. Let's say you've got your China facilities. So in China, that division might be tasked with not only making things and selling things, and therefore minimizing costs and maximizing sales, but it might also be tasked with setting up the facility, buying the fixed assets, buying the storefronts. And so whenever we get into the fixed asset part, adding that to the sales and the costs, well, that's going to be an investment center. So it's kind of different levels of accountability and I guess inclusivity about how much the different divisions would be focused on. So that's the responsibility centers. Decentralization is how much from the headquarters to the various divisions do you devolve responsibilities, and they result in these different types of centers. But please make sure you read the textbook or the PowerPoints to kind of get a fuller picture. So if you've got actual results and you've got a budget, well, naturally there's going to be a difference. And like I've said before, this difference we call the variance. Now, we can say plus or minus, but we actually use the terms favorable or unfavorable. And even though we may calculate it as a plus or minus, we have to interpret it. So these are interpretations of whether this number is good or bad. Well, as you can imagine, before we even get into all the technical decisions, if you had budgeted, oh, excuse me, about to sneeze. If you had budgeted 148,000 here, and let's say that we don't know if this is sales or cost, but let's say this is sales. If this is sales and you were budgeted to sell 148,000 but only sold 144,000, well, that would be less than the budget. You sold less than what you predicted, and therefore we would say that's unfavorable. So on the sales side, this would be an unfavorable relationship between these two. But if this was costs, and we said we were budgeting $148,000 of costs and yet you only ran $144,000 in costs, we would say that's favorable, that's better, your costs came in lower. So it's situational and it's an interpretation, and that's kind of what you want to have here. In this particular situation, so here I won't do all of them, but I'll do kind of like the first one or two. This is a difference of 3,700. And we would do a percentage. Now it's important to remember the variance percentage is a variance on the budget. So you would do 3,700 divided by 148. So in other words, it's not a variance on the actual. The actual was unknown until it came in. The variance is based upon what you had budgeted. So this would come in at 2.5%. And looking at the fuller question, I see that they're determining this as unfavorable. So this would be a sales target, right? Because if you came in under the budget and you're declaring this unfavorable, you didn't make as much as the budget. So similarly here, the dessert is a difference of 1,400. And once again, that's under. So we would say that's unfavorable. And that percentage is, just taking a look at my previous calculations, 8. And so you would go ahead and figure out all of these. So just remember, the variance is the difference, and you can figure out the percentage based upon the variance to the budget. And then favorable or unfavorable, that's going to be situational on whether it's a sales or a cost. Now, part of the, I guess, tracking how you're doing is a number of different measurements. So in addition to the variance, that's just telling us the broad, did we make the budget or did we not make the budget? Were we over, under? There's a couple of other, and if you're a finance major, you'll get into a whole lot of these. And in accounting, we look at some of them. We look at kind of the basic ones. But as you can imagine, we not only want to know were we over, under, but we want to know either some ratio or kind of what it doesn't mean to us. And so 10.3 is looking at that. What do they mean to us, and can we track them versus other companies, and can we contrast and compare? So the three we're looking at is ROI, sales margin, and capital turnover. Now, once again, they give you some, over time, I've just thought these are names that are strange. I don't want to say strange, but they're not standardized. And you'll see what I mean here in just a second. You notice that we're working with 3 items. So we have 3 different departments. These are income, assets, and sales revenue. So this is kind of like the profit, the amount of assets you used, and the total, the top line sales. So you notice we have 3 items, and we have three different things. We've got sales margins, capital turnover, and ROI. However, these two are very similar, and all 3 of them are related. So I think most of us know what sales margin is, but just kind of let's think of it is, what is our amount of profit? That's the operating income, to the amount of sales, right? So if you sold $10 worth of items and you came away with $2, well, that's 20% profit. And that's all that we're doing here. So this one is going to be a profit of 28%. So that for what you're kind of saying is for every $1 of sales, 28 cents is profit, or 28 cents is your margin. Now, you'll notice here that we take both operating income. So this is a ratio of the operating income to the total sales. And then we look at both of those. We look at operating and income as it compares to total assets. And why is that interesting to us? It's interesting to us because we have to invest in these assets, and we kind of want to know how much, we buy a store, or we buy a manufacturing plant, or we buy a bunch of machines, and we want to know, are those machines being effective? Are they being efficient? How much for every dollar of machine that I buy, for every dollar of machine I buy, how much profit or how much sales are they generating? So we look at the ratio of operating income to sales, and then we look individually sales to assets and then operating income to assets. And even though those seem like relatively simple concepts, you notice that they use some very odd names. Return on investment, okay, capital turnover. So don't get so caught up in the names. Just realize kind of what we're comparing things to. So you have 13,000 in total assets. What did they generate for you as far as top line sales? Well, here, now, once again, notice that we look at this as 1.7 times. We could also think of this as 170%. And then operating income to total assets, well, this comes out to 47, kind of an odd number, 0.6%. But if we divided 47.6% by 170%, we would actually get 28%. So all three of these numbers are related, and just kind of understand what they're telling you. This is our profitability, that's the sales margin. This is for every dollar of assets, what are the total sales it's generating? And for every dollar of assets, how much profit are they generating? So that's another one of these performance target measurements that we would measure when we go through and look at variance and whatnot. In other words, we may be trying to improve sales margin, and improve capital turnover, and improve ROI. So we would track this over time, or we compare it to another company to say, are we doing better or worse than they are? So the next question, well, we're going to jump down to question 6. And in fact, it's almost the same question altogether. And I'm not going to redo those three calculations here because we just did them. They give you the same amount of information, and they ask you to calculate sales margin, capital turnover, and ROI, which are the things we just looked at up here. So you would just use the same equations to calculate that from this. They do add one extra one, and that's why I'm kind of picking this one up, is that they have what's called residual income. So if you remember in a previous chapter, we looked at something called margin of safety. And that was kind of a buffer, right? How much above break even are we selling? This is something similar. So as I was explaining, total assets and operating income, that's our ROI. You may have a targeted ROI. You may say, we have in our industry, every dollar of asset should give you $14 worth of, or 14 cents worth of profit. So you would say this may be the industry average, or this may be what we're targeting. So you're saying we have this many assets, and this could be a whole lot, could be 15, this could be in millions, right? So it could be a whole bunch, or it could be in thousands or something like that. So we first calculate a targeted return, and then we subtract it from our operating income. And what this gives us, and it's actually this amount, this is how much over our expected rate of return. So if we expect 14 cents, we're getting off of the 15,000 in assets, we're actually getting this much more. So it's not exactly the margin of safety, but it's kind of approaching it the same way. How much better than our targeted rate of return are we doing? Margin of safety is how much better than the break even are we doing? So it's a related concept, but just realize that you're using this targeted rate of return, which is sort of similar to your ROI. ROI is based upon your assets and your actual operating income. This is based upon an expected ROI, a targeted rate of return. So this is the extra one that number 6 draws into it. Okay, so interestingly, this textbook introduces the idea of flexible budget in this chapter. Typically, we do this only in the variances, but I think it's probably okay that we kind of approach it here. So we spent all last chapter looking at what we call the master budget. And we just talked a little bit about now that how we have actual results. And at some point, we want to compare those. But there's an extra step that we need to take to be able to compare it. And let me give you kind of a simple example. So I'm not going to say these are dollars or items or whatnot, but let's just say that your master budget is 10, and you're expecting that the costs are 6. So if you notice, this is kind of a 60% ratio here. Well, your actual sales were 15 and your actual costs were 8. Did you do better or worse? Well, you have more costs. Obviously, you have more costs, 8 versus 6, but you also had more sales. So it's hard to directly compare whether you did better or worse. So what you need to do is you need to scale this up or down, depends upon whether the actual results are above or below your master budget. But in this case, we have to scale it up. So if we said, okay, what would the master budget look like if we had actually budgeted 15, right? So in other words, we take the actual results of 15 and we say, okay, what would the master budget have looked like? And that's why we call it the flexible, that's the scaling part. If we had 15, well, we would use the relationship between these two, which is 60%. So I would say, well, if we had actually budgeted 15 and we were going to stick with our 60%, the cost would be 9. Now, because the sales are the same, now we're comparing apples to apples, essentially. And now we can say whether things are better or worse. Just looking at actual results versus the master budget, if the volume, if the 10 and the 15, are different, it's hard for us to look at any of the other numbers and exactly see whether they're good or not. So the first thing you need to do is scale the master budget volume-wise up to the actual sales, actual volume, and then recalculate the cost according to the master budget, percentages or ratios. And the difference between the flexible budget and the master budget is called the volume variance, because we've changed the volume. And this variance between actual results and the flexible budget, well, that's called the flexible budget variance. And there's actually, we'll delve into this particular thing a lot more in chapter 11. So we're not as concerned with volume variance. In fact, I'm a little surprised that this chapter wants us to look at the volume variance, because it doesn't make a whole lot of sense, but understandably, we sometimes look at it for various things. So let's go ahead and look at it, just knowing that we're usually more interested in the flexible budget variance, because that's comparing apples to apples a little bit more. Okay. So here, now I realize that the problem in the text in the homework will give you a bunch of these numbers in the flexible budget, but I want to talk it through so that you understand where they come from first. So just like I said, the master budget is 12,000 items. The actual sales volume was 13,000. So our flexible budget has to be scaled up to 13,200. So you notice that we have this number here, $26 per case. Well, that's not the relationship between these two. That's not how these are calculated. This darn auto. That's not how these two are calculated. This is what we call a standardized number. In other words, that's how the 12,000 to the 312,000 is considered. So what I would do is take this 13,200 and multiply it by 26 to get, okay, if our budget is $26, I guess I should say this is the budgeted number, not the actual number. So we would say, and I've actually calculated over here, this would be 343,200. And same with this. I would say, okay, if I have 13,200 and it's $2 per case, that's my budgeted amount. So you can see 12,000 times 2 is 24,000, right? That's how this number is got. So if we were to take 13,200 and multiply it by 2, we'd get 26,400. And so on and so forth. Down here, we'd take the 5. Now this is calculated as a, we would actually figure these all out and subtract it. So if we took 343,200 less 26 and 4 and 66,000, we would get down to, let's see, 250, and I have the rest of it, 250,800. So this is a calculation. This is a calculation. Okay, so let's take a look. Now we're going to get down to a little bit of the compare and contrast. So let me take that off so that doesn't jump up. Okay, so when we look at the volume variance here, we see that this is different by 31,200. And like I say, this one is not as good or not. Well, in general, what we're going to find is that, just like we said, if you're selling more than your budget, well, this is a favorable. And like I say, it doesn't make sense because we've just scaled up. But let's just go through and input what they're asking for. Here, well, naturally, the costs are going to be, the expenses are going to be more than the master budget just because we've scaled it up. So this is up by 2,400. And this is unfavorable, and so on with this. This is an additional 6,000 more than we did in the master budget. But the contribution margin, because the sales is up, is going to be more. So this is favorable. Now notice down here that I've left these numbers from the master budget. And why is that? Because fixed. Remember, fixed by definition means an expense that does not change with volume. Remember, we went through that whole thing of what's the difference between a variable expense and a fixed expense. Theoretically, this amount should not change. These two amounts should not change, even though we had more or less volume. Now, actual results are different, at least for one of them, so we have to compare that. So this is, by definition, is going to be 0. And I don't know if it's favorable or not, but that's kind of what they're looking for there, favorable. If we were to go through and do all of this, 250,000 minus 800 minus those two, we get to 236,500, and the difference is going to be, well, it's just going to be that 22,800 that we had here. And once again, that's going to be favorable. Okay, so like I said, the volume variance is not as interesting, and it's a little bit kind of redundant, but okay, they asked for it, let's pull it in. What we are interested in, want to try and find out, is a little bit more about this flexible budget variance. So we can see here the difference between, even when we have matched the volume. So we have a budget of 13,200 and we've got actual results of 13,200. Now we can look at what is the sales revenue versus what is our budget. Well, the sales revenue, well, the difference here is 5,000. And we can see the actual results of sales was below our budget. So we would consider that unfavorable. We did not sell as much as what our budget would suggest we should. Here we have expenses, 24,500 versus 26,400. So that's a difference of 1,900. Now, because the expense is lower than the budget, we would say that's favorable. Shipping, again here, this is going to be less by just 500, but it's less, so that's favorable. I guess I got to make that F bigger. And therefore, when we calculate all this, the contribution margin is going to be, well, the contribution margin is under by 2,600. Now, we want the contribution margin to be more. It's less. So ultimately, even though the expenses were favorable, the revenue was more unfavorable. In other words, this 5,000 of unfavorable outweighed the favorable less expense. Now, theoretically, these should be the same, but the actual results were that salaries were more. And therefore, we would say this is unfavorable. This ended up being the same. That's favorable. And when we calculate it all out, that's another 4,000 difference between these two. And because the operating income is less than what the budget, we would say that's unfavorable. Now, in next chapter, we're going to actually break down this flexible budget variance a little bit more. We're going to look at two components. So this is the first breakdown. And like I said, we normally don't look at volume variance. We're just aware of it. But the importance is to scale up the master budget, to be equal to the actual, and then recalculate the master budget. That's what we call the flexible budget, and then compare it to the actual. Now, once we get to this item, we're not sure whether it was because of volume or costs, or we'll actually look at the breakdown of the flexible budget variance in the next chapter. But it did introduce it in this chapter, and so let's start thinking about the difference between actual results and the master budget and how we have to scale them to be able to compare them. Okay, that's the end of this chapter. If you have any questions, please let me know by email or catch me on Zoom. Have a good day.